So let's say, so your positions are smaller, you've cut positions, but what are you doing? Or you're not completely sitting in cash?
Okay, so my guess is, and I believe the market is topping, but you know the economists have the stock market predicted 7 out of the last 3 recessions. I predicted 7 out of the last 3 bear markets. I started in a bear market in '76, so I'm kind of poisoned. I have a bearish bias. But where I am on the market right now is if you gave me a stock I really like, I'll buy it, and if you gave me a stock I really hate, I'll short it. But in terms of having some big position, long or short indexes or some exposure to the stock market, right now I'm lost. And I don't play when I'm lost. And I know in the future I won't be lost, and I'll play big then, but I don't.
You can sit in cash because you're managing your own money. Clearly, you ran a hedge fund. I could sit in cash when
I was managing other people's money, Stephanie.
Well, for other managers out there, can they say, I'm going to take 2 and 20 and not invest?
I don't know. The way I always approach the business is you give me a pile of money, and I'm going to try and pound that money for you over time as best I can. This whole quarterly performance and risk-adjusted stuff that's invaded the hedge fund industry, I don't get it, and frankly, for other than 10 or 15 managers, I can't imagine why anybody would pay 2 plus 20 to what's out there. You know, when I started in the business, there was me, George Soros, Julian Robertson, Paul Tudor Jones, or Bruce Kovner. We were expected to make 20% a year in down markets. There was none of this, oh, I've got a risk-adjusted return of 8 in this. That's how 2 plus 20 came about.
So why are hedge fund managers so much less successful now than they were then?
Well, there's just too many of them. There were 8 to 10 back then. Somehow, 9,000 people are pricing their product off of 8 to 10 people's historic performance. And I noticed in the late 90s, early 2000s, a lot of these smart early investors in hedge funds, clients, were leaving, but they were more than replaced by state pension funds, sovereign wealth funds, and so far they've been perfectly happy to get returns that our early investors would have never tolerated.
Do you invest in other funds?
Yes, I do.
How do you make a decision of who you want to invest with?
I meet with them, and luckily I've been in the business 35 years, so I think I have a pretty good edge about what makes them just go over their investment philosophy and see whether they can make money over time.
As a hedge fund manager or a former hedge fund manager, what do you think about the media circus around credits like Herbalife and all these big personalities and names involved? This isn't the way Stan Druckenmiller invests.
Well, to each his own. I'm surprised because I always thought that publicizing your positions was not a good thing. It might be great for a day or two, but these people forget you got to get out of these positions.
But when you watch all this, you don't suddenly say, you know what, maybe I want to go long Herbalife here. Maybe I want to go long Apple.
The only time I really got interested in Herbalife is when you guys did the show on Bill Stieritz. That got my attention because that's not some guy that's trying to do a day trade or somebody short or this or that. That's a serious investor, and that would get my attention.
What else is getting your attention these days?
Well, I'm very focused on the new Fed chairman, and I'm perfectly willing to wait a few weeks to find out.
So that leads me to a question. If you've got the small, you were saying earlier, the smallest positions that you can remember, right? You may have ever had.
In most things, yes.
Okay, so, and you also have a great track record calling bear markets.
Yes.
So,
by the way, it's not that great because I've called bear markets that didn't happen.
How does it feel to you right now? How close are we to a bear market?
As long as the Fed is printing money, not very close. That's why the issue of tapering and where we go with it is so important. I don't really care whether we go to 70 or 65 in September. But if you tell me QE is going to be removed over 9 or 12 months, that's a big deal because it's my belief that QE has subsidized all asset prices, and when you remove that subsidization, the market will go down.
So asset levels for asset prices, right, and that would suggest that a lot of what we see in asset prices is illusory, that if you take the Fed away, the fundamental underpinnings just aren't there.
My first mentor and boss, Doc Drellis in Pittsburgh, used to tell me it takes hundreds of millions of dollars to manipulate a stock up. But the minute you have this phony buying stop, it can go down on no volume, and it can just reprice immediately. I personally think as long as this game goes on, assets will stay elevated. But when you remove that prop, and let's face it, the Fed has said they're targeting asset prices, those prices can adjust immediately. June was very instructive because if you didn't believe before that the exit was going to be tough, the mere hint that maybe in 3 months, if the economy's good, we might go from $85 billion a month to buying $65 billion a month, cause that kind of havoc and risk around the world. How in the world does anybody think when the actual exit actually happens, prices are not going to respond? It's silly.
Stan, you said you have the smallest positions in most things. Most things has me thinking, well, what do you then have big positions in?
I don't have what I would call it takes courage to be a big positions in anything. I am long some Japanese equities. I am short some yen. But in terms of big outsized bets like I had earlier in the year in something like Australian dollar, or frankly, my bets in Japan were bigger earlier in the year, everything's sort of down and waiting for the next big shot.
You're George Soros' former business partner. You and George worked together for many years. A couple of years ago, George told me that hedge funds can be very destructive to economies, in particular because they're always looking for weak points. And now that he's not speculating any longer, he's on the side of the angels. Now, whether George is on the side of the angels or not is a matter for debate. But what's your view on hedge funds? Are they a force for good or a force for evil?
I'd say they're neither. I'm surprised George said that. I'm sorry I missed that show. What I would say, and because George is more in the macro world, is that specifically he's probably talking about currencies. I mean, I would think that would be the best example. I've made some currency bets, and if you don't have the fundamentals with you and they're not right, you may win for a little while, but you're going to lose. And I will always believe, you brought up the British pound in the pre-show.
And you were talking about the Aussie dollar just a few minutes ago.
Yeah, that was a good event for Britain. On the other hand, there's some...
A good event, why? Because it hastened the inevitable?
Because they were linked to the German economy, which had just done reunification. They had an inflation problem and were exploding in growth. Germany, Britain had a housing problem. Interest rates were too high there. You could not have had two more dissimilar economies, and they shouldn't have been linked. And what happened when they broke the pound, they were freed up to follow an interest rate policy that was consistent with their own country's needs. And in fact, not to be an apologist, but that came to be known as White Wednesday a year later as opposed to Black Wednesday. And gilts went crazy, the stock market went crazy, and the British economy recovered. On the other hand, I've made some bets that have been dead wrong, and the market punished me.
Well, I want to go back to QE. If you think about QE and what asset class has been manipulated most because of it, would you say stocks or bonds?
Oh, I would say stocks. I have been really wrong on the bond market in the last 3 or 4 months.
How?
I have been waiting for this decline for 2 years, and I completely missed it because, first of all, the stuff we're talking about earlier in the show, that's too far down the road, in my opinion, for the bond market to pay attention of. But I have always found in bonds, if you can predict a relative change in the economy relative to consensus, you'll make money in bonds if you get that equation right. And 2 or 3...
Even in a world of QE?
Yes. And 2 or 3 months ago, I thought people were overly optimistic on the U.S. economy. It's my judgment that that assessment turned out to be correct. But bonds went down anyway for non-economic reasons because we have the unwind going on. And for whatever reason, while I anticipated that down the road, I did not think it would happen while the economy was softening.
Well, are you concerned that we're not going to be focused on the economy again, or at least those in D.C., because we've got Syria to focus on?
Well, I think we'll always be focused on the economy. I am a little concerned that the Fed chairmanship appointment could get hung up. I think it should have already been made. It's become a complete circus. You've got economists opining on it. You got politicians opining on it. You got newspaper people. My God, Obama should just go in the Rose Garden and appoint whoever he wants to appoint. That's his privilege and his job.
Stan, I want to go back to how we started our conversation and try to pull it all together. Generational theft, this idea that entitlement programs are effectively stealing from future generations. How do you put it all together? How does your investment philosophy reflect your personal views?
I wouldn't say it's my investment philosophy. It's just a concern I have. And let me say, when Al Hunt said this is easily fixable, I think it's a mistake most people make in investments. They look at the present instead of the future. And if you analyze the debt as stated out there, it looks like it's fixable. We do a little chains here, a little chain here. Eric, that's not the case. Those charts we showed earlier had no demographics in them. What's going to happen now? Because 1947 is when the baby booms start, and fertility rates were over 3 then, and they're 2 now. For the next 20 years, every day, 11,000 seniors. Every day, we're going to have 11,000 new seniors. And this is going to make the numbers of seniors who are getting entitlements explode relative to the working population. So instead of having 5 workers supporting an entitlement, you're going to have 2.5 workers. And that is not on the government balance sheet. When you hear this stuff about the national debt being 12 trillion or 16 trillion, depending whether the Fed or the Treasury owns it, if you actually took what we promised to seniors and future taxes and you present value both of them, that number is $200 trillion. That is the problem when you take the debts of future payments to seniors and put them on the balance sheet, and for God's sake, they should be on the balance sheet. And in fact, I mentioned an organization earlier, that the Can Kicks Back. They have sponsored a bill in Congress, the Inform Act, which will bring that. So
True transparency.
True transparency, which is a Bloomberg hallmark. We need at least to get that on the books so people see it. The other thing that annoys me on this problem, and then we can move on, is all the solutions.